Right now, shares of Wellgistics Health, NASDAQ WGRX, are trading at $1.20, which is a staggering move of 197.8%, or about 80 cents to the upside on the day. The market is absolutely electric around this name. But the first thing you have to look at isn't the price, it's the volume. We are seeing 475.7 million shares trade hands. To put that in perspective, the entire float of this company, the shares available for trading, is estimated to be around 40 million shares. This means the entire company has been bought and sold, in theory, more than 10 times over, and it's not even lunchtime on the East Coast. This isn't investing, it's a high-speed game of musical chairs with an unprecedented number of participants. The intraday chart looks less like a stock and more like a seismograph during an earthquake, opening around 88 cents, exploding straight up to a high of $1.46, and now vibrating violently around that $1.20 level. This is the kind of volatility that creates and destroys accounts in minutes. The expectation, the narrative that is clearly fueling this fire, is that Wellgistics Health just became a major player in the next big technological shift. You see the headlines, a partnership with DataVault AI. You see the key words, blockchain, AI-powered, and pharmacy chain. The immediate assumption for anyone seeing that 197% gain on their Robinhood app or SoFi Invest feed is that this company has just secured a transformative, locked-in deal that will change its fortunes forever. The expectation is that this is the ground floor of something massive, and the reality of its 40-cent price yesterday morning seems like a distant memory. This is the kind of story that traders dream of, catching a microcap before it rips, and today that dream appears to be coming true. But we have to separate the expectation from the reality. When we look closer at this partnership, what is it really? The filing and press release clearly state it is a non-binding letter of intent. A non-binding letter of intent is not a contract. It's not a commitment to revenue. It is, quite literally, an agreement to talk about maybe doing something together in the future. It's a statement of exploration. In the world of corporate finance, this is several steps removed from a finalized revenue-generating product. The reality is that the market is applying a valuation surge of nearly 200% based on an idea, not a product, on a press release, not on purchase orders. This isn't NVIDIA stock posting billions in actual data center revenue from AI. This is a company saying it wants to get into AI and blockchain. This is the critical disconnect that sophisticated traders, perhaps using platforms like interactive brokers, are looking at. They see the frenzy, but they also see the fundamentals. Let's look at the reality of Wellgistics Health before this non-binding letter of intent was announced. This is a company with a market capitalization that, even after today's surge, is only around $108 million. This is the very definition of a microcap stock, which makes it highly susceptible to these kinds of wild swings. Now let's look at the financials. The company's trailing 12-month earnings per share is negative 90 cents. They are not profitable. Their TTM revenue is about $36.7 million, but their TTM EBITDA is negative $39.6 million. They are burning cash at a faster rate than they are generating sales. The balance sheet is where the reality check gets even harsher. The company's quick ratio is 0.10. That means for every dollar of immediate bills they have to pay, they have about 10 cents in liquid assets. The current ratio is 0.32. These are metrics that signal extreme financial distress. They don't have enough short-term assets to cover their short-term liabilities. Worse, the debt-to-equity ratio is over 2,700. This is not a typo. The company is financed by an immense, suffocating pile of debt relative to its equity. The return on equity is negative 1,071%. Fundamentally, this company was, as of yesterday, in a very precarious position. So, the expectation is that a non-binding AI partnership will solve these underlying problems. The reality is that this 197% price spike might be the very thing the company needs to survive. What does a company with a distressed balance sheet do when its stock price suddenly explodes? It raises capital. It sells shares. It's highly probable that this speculative frenzy will be met with a secondary offering, diluting the very shareholders who are buying in today at 120, 130, and 140. The new cash may help the balance sheet, but it comes at the expense of the new buyers. This is why understanding the difference between speculation and online investing is so critical. What's happening with WGRX today is not online investing. It is pure high-risk speculation. Self-investing in a name like this is a bet on market psychology, a bet that you can sell your shares to someone else at a higher price before the music stops. It is the polar opposite of putting assets into Schwab Intelligent portfolios or building a long-term position in Fidelity mutual funds. When you buy Apple stock, you are buying a company with hundreds of billions in cash and the most profitable products on earth. When you buy Tesla stock, while it has its own volatility, you are buying into a narrative backed by millions of vehicles and a massive industrial operation. When you buy WGRX today, you are buying a 475 million share tidal wave of speculation based on two key words: AI and blockchain. Let's talk about what the company actually does, because that's important context. Wellgistics Health is a pharmaceutical logistics and technology company. Their actual current business involves wholesale distribution of drugs to independent pharmacies. They have a network of over 6,000 pharmacies and 200 manufacturers. They provide third-party logistics, warehousing, inventory management, shipping for smaller drug manufacturers. They also have a digital platform called DeliveMeds, which serves as a prescription routing and patient adherence tool. This is a real, tangible business. It's a low-margin, tough, competitive logistics business. The expectation is that they will now bolt on a high-tech pharmacy chain and become a disruptive tech company. The reality is that they are a struggling logistics company that just announced a potential tech project. This kind of activity is not new. We see it in speculative markets all the time. A company in a completely different sector announces it's going to get into cannabis or crypto or AI, and the stock detaches from reality. The institutional ownership here is almost non-existent. Fintel reports show only about 6 or 7 institutional owners, like Millennium and Renaissance, holding a combined total of less than 1% of the company. Fidelity Brokerage or other large Fidelity wealth management arms are not major holders. This is a 99% retail-driven phenomenon. This is a crowd of people, likely coordinating and reacting on social media, all pushing through the same tiny door at the same time. The 475 million shares of volume is not a sign of health, it's a sign of panic, FOMO, and chaos. So let's look at the future outlook. What happens next? The expectation is that the stock will continue this run. People are calling for $2, $3, or even a return to its 52-week high near $7. The reality is that this volume is unsustainable. 475 million shares is an anomaly, not a new normal. When this volume recedes, and it will, the price will be left with no support. The massive number of shares that traded hands today means there are now tens of thousands of new bag holders, people who bought at the peak, 146 or near the current 120, who will be desperate to sell as soon as the price starts to fall. This creates an immense wall of selling pressure that will likely drive the stock right back down, possibly all the way to its pre-spike levels. The biggest risk, as I mentioned, is dilution. The company's management would almost be irresponsible not to use this spike to issue shares and raise the cash it desperately needs to fix its balance sheet. That is the smart corporate move, but it's a move that directly harms the speculators who provided the spike. The opportunity, if you can even call it that, is purely for day traders who have a high tolerance for risk, are using platforms built for speed like Interactive Brokers, and are looking to scalp a few pennies on the volatility. This is not an investment. This is not a place for investment help or for someone doing self-investing for their retirement. This is a gamble. I want you to comment below. What is the most volatile microcap stock you have ever traded, and what was the outcome? Let's share some war stories because WGRX is creating thousands of them as we speak. To summarize, the story of Wellgistics today is a perfect case study in expectation versus reality. The expectation, driven by a non-binding AI and blockchain press release, is that this sub-$1 stock is the next big thing, and the 197% gain is just the beginning. The reality is that this is a fundamentally distressed company with critical